past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. Our banking system is sound and resilient with strong capital and liquidity.
Now, if you listen to what he just said, right, everybody's really spooked by what happened to Silicon Valley Bank. Then we saw Credit Suisse do this major fire sale. So there's a lot going on in these financial markets. You got to be paying attention to it. I almost didn't want to talk about this today, but somebody got to talk about it, right? So let's get back to it.
We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. At today's meeting, the committee raised the target range for the federal funds rate by 1/4 percentage point, bringing the target range to 4 3/4 to 5%. And we are continuing the process of significantly reducing our securities holdings.
So what a lot of people don't realize is that when he says they raise rates to 4 3/4, almost 5%, right? That's the target rate for interest rates. That's the lowest barrier. And then you have what's also called the prime rate, where a lot of banks key off that rate to determine their loan amounts. So everything kind of goes back to the banks, to the interest rates from the Fed. So we're going to see prime rates increase. We're going to see interest rates increase on credit cards, and maybe even some more interest rate increase on mortgages. So it's going to be interesting as we get going along.
Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state
tighter effects, meaning that money flowing from banks and other lending institutions is not going to be so free willy. It's been free for a while. It's been very abundant and plentiful for a while. And this happens in every market cycle, right? So we're going through a tightening market cycle right now. So we're seeing that banks got spooked. They're like, oh no, we got to pull back. I can't loan to you for this new real estate investment project that's very speculative. Or I can't necessarily give you money for this business because I don't know if I'm going to get it back or not, right? And so you're seeing these runs on a bank putting fear, or I don't want to call it fear, putting reality back into bankers, into the overall financial system. Because again, we've been running with lack of discipline for a while. Like, so I don't know how many market cycles y'all have seen over the years. I've seen at least, 2000, 2001, 6, 7, 8, 9. So that's 3. And we had a few in between. So at least 4, right? So this is what happens quite often, right? People get enthusiastic. They go out and start businesses. They spend money. And then something happens. Somebody gets a little crazy. Somebody gets a little loose, and they do something crazy. You can go back to LT, long-term capital management. We can go back to the banking crisis or the real estate crisis, right? There's always these weird, exogenous, exotic events that kind of snap people up around a little bit financially and say, hey, it's time to tighten up. And that's what we're seeing right now. So let's get back to this.
That we anticipate that ongoing rate increases will be appropriate to quell inflation.
How seriously was a pause considered for this meeting?
So we did consider that. in the days running up to the meeting. And you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected. And really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of.
So you have a lot of people talking about the Fed is basically ruining the economy because they keep raising rates. Why? Because they want it to be sweet. They want to be able to get credit easily so they can get access to capital easily, money easily. But nobody's thinking about the bad side of this. I've talked about this a while, how a zero interest rate from the Fed is helping to widen the wealth gap, the black-white wealth gap, right? Because when you do this, the people who have money and means, when you have a zero interest rate, by the way, people with money and means, usually non-black folks, are able to borrow capital, put it to work, get returns at a much, much lower risk rate. Those without means are just kind of locked out largely because for a lot of reasons, right? But I think we all can agree that racism, systemic racism is still real and it still locks out a lot of people. Now, within these groups who have been targeted by racism, black folks, people of color, there are some who have been able and been fortunate enough to break out, defy the odds, and do some really, really dope stuff. But that doesn't speak to the majority. It only speaks to a minority, a small group. So it still begs to argue, why aren't more able to do that? Is it just because everybody's just lazy? Or maybe these issues are really deeper than some of the people on media, some of the people in politics really, really, really want to speak to. It's amazing why they don't want to give reparations, but that's another conversation for another day. All right. But again, they're saying now they're going to have to tighten rates because, again, inflation is running rampant. They don't have a control. They move too slow to start tightening up in the beginning. And I've been saying that for over a year.
Well, the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words.
So that was an interesting thing, right? I always love to pay attention to what's going on in the economy because all of this impacts us one way or another. You might not always see it directly in your face glaring, like higher gas rates or higher egg prices. Everybody was complaining about egg prices, but when it's time for you to go get a mortgage because you want to get a new home, you'll see the effects. When it's time for you to get a new credit card, you'll see the effects. When it's time to possibly get a loan for your business, you'll see higher interest rates. These are all effects from the Fed Reserve increasing interest rates. So make sure you keep that in mind. Make sure you keep that in mind. Keep an eye on the ball, y'all. Don't lose sight of that.